Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. South Korean chip stocks slide as Meta's AI infrastructure push raises fresh concerns over excess capacity, while Apple's talks with Chinese suppliers add pressure on the sector. Asian markets diverge with rate pressures, currency moves, and AI spending reshaping opportunities. Eastspring CEO Vis Nayar breaks down positioning across economies. Global investors reassess India as easing oil prices and currency support shift sentiment. PL Capital's MD and Chair Amisha Vora will discuss allocation trends and the valuation reset. And Bitcoin sees some gains after dropping to a 21-month low as ETF outflows weighed on sentiment. BitGo APAC MD Angela Ang will give us her outlook ahead. Well, the AI trade that has propelled global stocks this year is getting hit hard today. We also have investors weighing Meta's reported plans to sell excess compute and Apple seeking to buy Chinese memory chips. Avril Hong is all over those stories. Avril, Korea leading losses today.
Absolutely. I mean, you're seeing Asia stocks on the back foot. Korea leading losses. It's the memory names that are getting hit. That being said, though, it's interesting. You're seeing Japanese banks, South Korean banks, financials essentially, along with Chinese internet names, they are in the green today, and that's helping the Hang Seng as well. So maybe this is part of investors looking for new narratives in the second half of the year, aside from the chips trade. But there is a sense of flip the board, this rethink of how this AI-driven rally for this year, maybe that has started to outpace fundamentals when you think about how the likes of Meta could be looking to rent out compute. Does this mean it has been feeling the heat to deliver returns from its massive capital expenditure? And then with Apple also looking for the blessing from the US government for purchasing Chinese memory chips, does that also pose more competition for the dominant memory players? So you're seeing the chip stocks are down today. It's worth noting as well that overnight in the US, it wasn't just chip stocks, it was also AI infrastructure, cloud computing that got hit. And take a look at what you're seeing on this chart in terms of the US, South Korea, both on a performance volatility basis. Things have been looking really stretched. So you also get the sense maybe caution is warranted, especially in South Korea, where you're already still seeing that bit of foreign selling. Now, certainly AI is front and center. We have even been hearing from Kevin Warsh weighing in. Take a listen.
The AI boom is showing itself first and very prominently in the United States. I'd certainly rather have this problem where we have massive capital expenditures instead of thinking years back where we had financial engineering, where we had companies that weren't able to deliver profits, so they would do shareholder buybacks. Well, right now they're investing in the future.
Now, aside from the macro impact of AI, he also talked about how price risks are easing given where oil prices are. But maybe those that were trying to suss out the ornithological identity of Kevin Warsh from his comments are missing the point, given how he also reiterated that they'll refrain from forward guidance. Now, regardless, we did see in terms of Fed pricing for hikes that eased off after Kevin Warsh's comments, although October is still fully priced in. You can see that sort of reflected in the moves in the Bloomberg dollar index as well. And then now focus shifts to the US jobs report, right, ahead of a long US weekend. Has?
Avril, thank you. Well, our first guest expects Asian outperformance to continue as we see the end of the Iran war and accelerating AI capex. Vis Nayar is CIO at Eastspring Investments with assets under management of around $286 billion. Vis, good to have you with us. Before we take a look about your optimism in Asia, Warsh, he is front and center. I mean, this debate whether he was hawkish or not, regardless, but there is a softening in terms of his take on inflation.
Yeah, so thank you for having me here today. So look, Warsh is interesting. I think that he's now in situ and he has the role. I think there was a very, very important Supreme Court ruling recently that the president cannot remove officials of the Fed. So I think he is now in a strong position to be very clear. He came into this role with a very clear view that he thought the economy needed addressing. And I think he's just showing his colors and speaking more freely around this. So I think he views inflation as being a key metric. He was worried about that, and now he's obviously signaling that he sees some of that pressure easing.
And the market's pretty confident that we're going to see a rate hike by October. I mean, that doesn't necessarily change the way you deploy your capital.
Well, I think if we think globally, and especially around Asia, I think that rate expectation means that the dollar has showed some renewed strength. And I think in the context of Asia, in terms of the fiscal policies and the freedom and the flexibility of central banks in Asia, I think that is some concern there, right? I think that the strength of the dollar will mean some restrictions on what the central banks do in Asia. So I think we do need to pay attention to that.
A strong dollar, would you be buying Asia?
So that's exactly what I mean. So I think that in the context of Asia, we've had a number of dislocations which create opportunities. And I think from an investment perspective, we do think that it's not one homogeneous region. We talk about Asia as a diversification play, but I think the diversification is at the security and company level, and we need to be very conscious about where you deploy capital.
So where do you deploy capital in Asia? What's looking attractive?
So I'm going to go back to the start of our exchange here. So look, we continue to believe in the AI, this super cycle. So I think it's very interesting to see that pullback today, as we see some sentiment around overcapacity and indeed competition perhaps for some of the memory makers. The reality is that we still, some of the news flows are about few years worth of full order books. So there is quite a bit of visibility that capacity is still not there. I know that we're seeing some narratives around new capacity being built and coming on board. But the thing about deployment capital is that we think that is a structural growth story for Asia, and one that investors need to consider participating in.
Well, the pullback that we're seeing the most is actually from Korea. I mean, 6% downside in a single day doesn't seem very much. When do you start playing the Korean market again if you are in it for the longer term?
So you and I were discussing this. I think diversification is something that people talked about, but in practice, the AI theme has been a beta play in the first half of the year, and I think you didn't need to worry too much about diversification. I think increasingly, yes, the AI trade is potentially volatile in the second half of the year. Winners, losers, but the beta part of that trade is probably done. So diversification, you need to think about what are the different sectors and countries that are likely to give you that differential thing. So I think AI is a theme, one that's a structural growth story. Things like supply chain diversification, lots of things, a story there in hardware, really interesting. But also you can consider the resilience of Singapore, for example, the EQDP program here, aspects of ASEAN and India that have lagged, that potentially with end to hostilities, we can see some sort of respite in those countries which are now got more attractive valuations.
And of course, India is an interesting case. I mean, it does seem like India is benefiting from the pullback in AI. Being a non-AI story now benefits India.
Yeah, so we sometimes rally against this. I think at the index level, India is viewed as a sort of a non-AI story. But there are technology opportunities in India. This is something we often try and get across to our investors. As active investors, there are cases, but of course the market as a whole has a lot of different sectors which have been under pressure. But I think really this is an oil story and it's an energy story. India has had a real challenge with what's been going on in the early part of the year. But as we come to an end of hostilities, as we see some sort of deal, as we see oil prices coming down, potentially India is now a real uncorrelated trade. The Indian market has been very uncorrelated with the US. And so that's another opportunity when you look and seek for diversification.
Interesting you talked about energy in India. The monsoon has a huge impact on the Indian economy. Isn't that a risk in investing in India right now?
Well, I think monsoon and second order effects from there as well. I think from an inflation perspective, we can be hopeful around the oil price coming down, but I think there are some concerns looking forward around food and the cost of food. So I think monsoon ties into a little bit of that as well. I think that we are concerned and worried about how food price inflation comes effectively upstream inflation comes through into Asian economies. So I think that is a risk. But again, diversification is about diversifying those risks that we inevitably will have.
How are you assessing the risk from the strong dollar? We've seen how the Korean won has been impacted. The yen, of course, hovering at 162 and change. How might this play out for the respective markets?
So I think when we think of Korea, we think it's quite a concentrated, focused trade on AI. So I think that there's a little bit of price insensitivity around that. We've seen that order books are full. So I think Korea is a very specific and specialized trade. When we think of Japan, there's a lot of different actions in place. So the government has come out and said they are not against intervention, but so far an orderly move in the yen-dollar rate, I think, has been adopted. I think if we look back in history, Japanese companies have been historically very able to deal with these environments. There's corporate kind of knowledge around that. So an orderly depreciation is probably be tolerated. From our point of view and our positioning, we're much more concerned about anything a bit more sudden and sharp. We think that is a risk investing in Japan, and that's a risk that one needs to think about, especially around fixed income.
So in terms of yen levels, I mean, lots of numbers out there. People say watch out for 165. Forget 165. I've seen 180, 190, even 200. I mean, how are you assessing the risk of the yen at 200?
Yeah, so I think it's a journey. So I think, I'll go back to what I've just said. We think there is a slow move. And I think that
slow move towards.
So towards, we think we're at the 160, potentially up to 170, up to 80. I mean, 200, I think, is a kind of a much more extreme view. I think at some point
the government. 180.
So the government will have been very clear. There will be intervention. So that is the risk. It's not a simple journey that is likely to be a straight line. The more that moves, the more the government is likely to intervene. I think where we are now, an orderly depreciation can still continue for a little bit, but there will be a time when there's intervention. So I think projecting a 200 is quite an extreme move from where we are now.
We have hawkish Fed in a way, expectations of a rate hike. Doesn't matter what the BOJ does as long as the Fed remains hawkish. It's like putting money into a black hole.
Black hole. The BOJ is, I think one needs to view the BOJ as doing its normalization. So it's since the first time in 20, 30 years we've got more normalized interest rates in Japan. So a rate hike in Japan is just normalization. So of course they're going to have to use those policies as the hawkish, we still need to see all of those rate hikes in the US come through. I think from a Japanese perspective, we've seen a little bit of dislocation in the bond market. Certainly, I think the long end of the bond market is a little bit worrisome. I think we've seen some yield to term premium coming through. From our perspective, we tend to be a little bit underweight, but tactically interested if there's any short-term strength in the yen. But I think that's a little bit of a worry. How
best to position for the bond market? People talk about the high yielders. I mean, Indonesia has attracted a lot of demand lately. How are you assessing where you play the bond market? So
we're generally across the region still positive on credit. Certainly, it's the balance of risks are there, but I think we're still positive on credit. And we know that things like the Philippines, we've seen some interesting moves there, so there's some action in some of those markets. I think that we need to be a little bit thoughtful. I think we tend to be a little bit underweight duration. Term premium is something we worry about. Credit is where we are, and then we tend to be much more tactical. So if we have the opportunity to add, we will, but it's this concept of dry powder is very important at the moment in being tactical. What's the biggest risk there for the bond market? Well, I think you sort of we talk about the magic inflation word. So that we call it upstream inflation. Things like food prices, these are all very material in Asian markets. So I think there is this worry that inflation we're all expecting maybe at the macro level that oil coming down will rebuild balance sheets and give us lots of flexibility. But there is this worry that comes through at some point in the forward months. And Viz, before we let you go, what do you do with gold? It is inching upwards now. Yes. Gold continues to be a less correlated asset class. I mean, from an asset ownership perspective, it's also an asset class that doesn't deliver much by the way of yield, which of course is very popular in Asia. So we think it has a role to play. We do have some allocation to gold, but I think we're seeing strong corporate earnings. I think people forget valuations are clearly higher than they were a little while ago. Corporate earnings are strong. We've got a story on the war and energy coming down. Yes, we have some inflation risks, but you've got an incredible opportunity set around improving earnings, around great stories, around great sectors, structural growth in Asia, diversification.
And yet, someone like Bailey warns about a bubble and leverage positions.
Of course. I mean, there are many concerns on that dimension. So, for example, we worry about retail participation in places like Korea. The AI trade really has a strong foothold there. I think you need to be discerning. So we always come back to think of Asia not as a homogeneous market, think of it as a heterogeneous market. Each country has a different opportunity set. Focus on valuations and the corporate story, and you might do rather well.
And you heard it here. Vis, thank you. Vis Nayar, CIO at Eastspring Investments. Well, Apple is said to be in negotiations to buy chips from two Chinese companies on a Pentagon blacklist. It's trying to reduce the impact of a global memory shortage that's forced it to raise prices across its product line. Bloomberg's China correspondent Min Lo joins us now for more. Min, is this going to face opposition from the U.S. government?
Well, I think Apple is really trying to preemptively protect itself from any potential geopolitical risk, because technically Apple doesn't require the blessings of the U.S. government to buy from these two companies. They are blacklisted by the Pentagon, but that prevents the Department of Defense from buying from these companies. It doesn't prevent a private sector company like Apple from doing so. Now, one of those Chinese firms, Yangtze Memory Technology, is also on a separate list, which is the Commerce Department Entity List. Now, this is different from the Pentagon list. It prevents U.S. firms from selling or transferring their technology to Yangtze Memory. But in this case, Apple is not selling. It wants to buy from Yangtze. So again, it's not going to violate those U.S. export control rules. But of course, given the geopolitical environment, there's a lot of concern about over-relying on Chinese suppliers. So that's why Apple CEO Tim Cook, we understand, have been having conversations with the Treasury Secretary Scott Bessent, because they want to use these chips, particularly in those devices that they will sell only in China. And that's a bit to really reduce the fallout from any U.S. lawmakers.
Min, talk to us about Apple's current suppliers and how bad really is the supply squeeze?
So its current suppliers are the big three, which are Micron, SK Hynix, and Samsung. But the thing about these three is that they have been reducing the production of these DRAM and NAND chips and shifting to HBM chips in order to serve the data center, because that's a much more lucrative business for them. So that resulted in this shortage, unprecedented shortage that we have seen, that has pushed up Apple's product prices by about $100 to $500 for some of its iPads and its MacBooks as well. And that's why Apple is looking to diversify its supply chain to include some of these Chinese chip makers in its list. But again, that supply constraint likely to continue for a while more, because even though you have the likes of Samsung and SK Hynix and Micron looking to expand production capacity and build new plants, it's still going to take some years for those new facilities to come online.
So what then, if it's going to take some time, what then for Apple?
So for now, I guess we have to live with potentially higher prices, because some analysts, like our Bloomberg intelligence analysts, have said that maybe price hikes could be coming for those Apple iPhones as well. Now, those prices have not been raised yet. It's affected the iPads, the MacBooks, but because iPhones, especially the higher end models, they are seen as less demand elastic, that could potentially be the next target for price hikes if Apple is not able to control its costs, because without the diversification of supply chain, it's already going to hit its margins. It's delaying some product launches as well. So this is going to be a challenge that the new CEO, when he takes over Tim Cook in September, he will have to inherit this supply chain crisis.
Consumers will pay the price. Min, thank you. Bloomberg's China correspondent Min Lo. Now, still to come on Insight, we look at what's on the agenda for the Japanese Prime Minister's summit with India's Narendra Modi, as both nations look to reduce dependence on China. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Nissan's CEO says Chinese car makers are setting many of the industry's future standards with their technological advances. Ivan Espinosa also told Bloomberg that despite the weekend making Japanese-built vehicles cheaper, Nissan remains committed to producing vehicles in the U.S.
We will continue the strategy that we have set in the U.S., which is building cars in the U.S. We have two very large manufacturing sites, one in Smyrna, Tennessee, the other in Canton, Mississippi. And we will continue doing that. So to give you some numbers, last year, January, around 45% of our product mix was built in the U.S. The rest was imported from either Japan or Mexico. And we closed the year with 60% of our product mix being built in the U.S. And we will continue doing that because it makes sense. With the current context in which we're living, it does make sense to continue investing in the U.S. and continue bringing more cars into North America.
Given the current tariff environment, I believe for every auto produced in Mexico, it's about $2,000 or $3,000 more. What are you doing with that? How much is being passed on to the consumer, and how much are you just absorbing?
Well, we have a very aggressive cost reduction program, which we started a year ago when I took over the company, and we are focusing a lot on the products that are built in Mexico because they are cost competitive, but it's true they are currently tariffed 25%, which is it's making part of the lineup that we're bringing from Mexico difficult to sell. So we have a very strong cost reduction program on those vehicles because we do see an opportunity. Looking at the pressure that the U.S. market has today in terms of affordability, we see that potentially some of the buyers could be moving into these type of vehicles. So we are working very strongly on making them more competitive so we can probably take advantage of that if you can.
Ivan, can we wrap it up by talking about China?
Sure.
How difficult is it to compete with Chinese auto manufacturers?
Well, China is a world of its own, I would say. It's a very unique ecosystem.
What makes it unique?
I think the technology, speed, costs, they're moving at a very different speed than the rest of the world. And for me, it's important to remain present in China because I believe a lot of the future standards of the industry are being set by some of the Chinese players today. Again, in terms of speed, in terms of costs, and in terms of technology. So for me, the role of China is twofold. One is, of course, continuing to produce and sell cars in China because we have over 15 million users of Nissan products in that country. So we owe them product that is competitive and that is attractive for them. But at the same time, it's a place where you can learn a lot and you can start exporting some of the methods, some of the processes and new ways of working that we have discovered there.
Can you give us an example? What can we learn from what they've done at an industry right now that they seem to be dominating?
Well, one of the things is when you look at the products in China today, almost 80% of the products that are offered have autonomous technology embedded. And customers are now not considering to buy a car if you don't offer some level of autonomous technology. So this is just an example of what can happen and what we can imagine coming out from this unique ecosystem that they have.
All right, still to come on Insight. We speak exclusively with BitGo's APAC Managing Director Angela Ang on the sector outlook as Bitcoin tumbles to a 21-month low. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside. Japanese Prime Minister Sanae Takaichi has arrived in India for a 3-day trip to deepen economic ties and strengthen security cooperation with a counterpart Narendra Modi. That's as the two Asian powers seek to reduce dependence on China. For more, let's bring in Bloomberg government reporter Sudhi Ranjan Sen in New Delhi. And Sudhi, what are the focus areas for the talks?
Well, the major focus areas of the talks, as we are picking up, and my colleague from Tokyo, Sakura, and we've been reporting, is economic security understanding, and it's an umbrella understanding that seems to be being discussed and likely to be announced, which will have everything from energy to semiconductors to critical minerals. So that is going to be a kind of a focus of the entire visit. Besides, of course, signaling a deepening of cooperation and deepening of relations and ties between the two countries.
So talk to us about the kind of outcomes that can be expected then.
wide-ranging outcomes are expected. In fact, from what we've picked up, at least 10 or nearly 10 agreements we are hearing between the two governments. We are also just reported today in the morning that the business-to-business cooperation is really going to see a jump, and with some Japanese newspapers reporting over 100 understandings and agreements between the two businesses of the two sides are expected. Mind you, there is a big Japanese business delegation that is accompanying the Prime Minister, and there is a business summit as well where the Prime Ministers are going to address. So at the government level, there is going to be around 10 and several more at the business-to-business level.
And what is the geopolitical framing of the visit? I mean, we know that both countries want to cut the dependence from China.
So one of the key geopolitical framing that is coming out of from this visit is at the back of all this, at the background of all this, is the meeting between President Trump and President Xi. A few weeks ago, where there was some kind of the impression is that United States and China are trying to stabilize their relationship. That is kind of spurring or kind of encouraging better ties between the middle powers in South Asia. Japan, of course, an economic powerhouse, developing its military. India is trying to build up its economy and its military. So that is the geopolitical framing of this visit.
Sudhi, thank you. Pullback government reporter Sudhi Ranjan Sen in New Delhi. We continue to track the market reaction to Kevin Warsh's comments that price risks are easing and the impact on riskier assets. Avril is back with a look at Bitcoin. Oh boy, how it has dropped.
Oh, it's dropped, but it's also bounced higher a little bit. And this is given how traders have pulled back their bets of aggressive rate hikes following on from Kevin Warsh's comments. So overall, the backdrop seems a bit supportive. You look at gold today, but also Bitcoin after dropping below the 60,000 handle and earlier in the week to the lowest levels we've seen it in 21 months. It is back above that level. Now, that's not to say that these Fed rate concerns are not still there, especially given the potential for tighter rates and what that means for investors potentially diverting capital away from assets that don't pay a yield. Now, flip the board. The crypto conversation this week has also been the financial disclosures of the U.S. president, and we've learned that last year his crypto haul was $1.4 billion. That makes him the largest U.S. crypto money maker, beating out even the largest of these U.S. firms. And then also keep in mind that some firms really lost a lot of money amid the crypto selling that was brutal. Has
the crypto president, they say. Avril Hong, thank you. Well, to help us unpack the outlook for Bitcoin, we're joined exclusively by seasoned voice in the blockchain space, seasoned voice on Insight as well, Angela Ang, APAC Managing Director of BitGo, a digital asset infrastructure company that secures roughly 20% of all on-chain Bitcoin transactions by value. Angela, good to have you with us. So Avril defended. She said Bitcoin has bounced 3%. What's 3% when you're down 50?
Well, that's the market for you, Has, and it's so great to be back here this morning. I think, what we're seeing in the market today, some of these pricing shifts, they are reflections of macro factors, right? And and things like rate expectations that kind of continue to be there, expectations towards a stronger dollar. Those are still, honestly, driving demand towards yield-bearing assets and away from non-yield-bearing assets. Not just Bitcoin. That's a general trend that we're seeing. But I think when it comes to digital asset, the story below the price, which is where companies like BitGo operate, is more interesting, right? And that's where we're continuing to see infrastructure build by institutions entering into digital asset continue to happen.
But you have to continue to monitor the reasons why Bitcoin is headed low. Some say this has a lot to do with strategy, right? Because this is a key player. It's one of the biggest holders of Bitcoin. If it is pulling back, then the support is no longer there.
Well, Has, I think we need to distinguish one company's kind of balance sheet decision, which is really what that is, from structural market demand. And of course, we are looking at a macro repricing right now. But I think underlying that, we're still seeing at BitGo institutions, regulated institutions that are investing heavily into digital asset infrastructure. And that's a mid to long-term play. I think that demand is still there, the belief is still there, and we continue to work with our clients towards that.
How about the other factors, right? I mean, a hawkish Fed is also pretty bearish for cryptocurrency. We have the currencies like the yen, the weakness in the currency at 162, 65, whatever the case may be, is also detrimental to cryptocurrency. All these factors are also in play.
Yes.
By virtue of that, can we expect Bitcoin to continue to tumble lower?
Well, I think at the end of the day, Bitcoin, like all other asset classes, will react to these kind of macro factors. But I think, what we're seeing in the markets today, that's the portfolio allocation story, and that changes with kind of how the market is moving. But the story that BitGo and our clients are more interested in is the infrastructure build. And that's something that we discussed a lot even last year, right? That regulated institutions are coming into digital assets in a big way, and they're investing in infrastructure. And that is something that, we continue to see, BitGo as one of the leading digital asset infrastructure providers. We work with our clients to help them to buy, sell, and store their digital assets in highly regulated environments. And we continue to see clients, in fact, in quiet markets, that's when, clients are motivated to build, because by the time the next upswing comes, you want to be ready for that.
Do you see forced liquidation risks at current levels?
I think at the end of the day, it's kind of that people are watching the market, right, and they're monitoring these macro factors, and that applies, I think, not just to Bitcoin, not just to cryptocurrencies, but to a wider range of asset classes. And again, that is really a portfolio allocation story. I think the story that we are really focused on is the infrastructure build, and from that point of view, in terms of flow, we do see demand for digital assets. In fact, BitGo Singapore's prime brokerage business has actually seen our volumes more than double from in the first half of this year compared to the same period last year. And I think that is reflecting a kind of like underlying institutional demand that is driven by infrastructure and a belief in the long-term future of digital assets.
Can you draw that distinction between the Singapore market and the others? I mean, where is there correlation and where are there differences?
I think this is Singapore, right? We are an open financial center. There will always be correlations to global financial markets. I think the attractiveness of Singapore, and this is why BitGo has chosen Singapore as our Asia-Pacific hub, is kind of like that regulatory clarity that we have in digital assets. I think Singapore has really been a leader in this space. In volatile market environments, this is where institutional capital gravitates to. When our clients know that BitGo is regulated by the MAS, they know that we are being held to a certain regulatory bar, and that gives them the confidence. In fact, I would say the rigor of regulation kind of filters out the weaker players, and ultimately institutions want to be working with the ones that will be standing on the other side of the downturn.
And do you see such volatility like what we're seeing right now, where Bitcoin is down 50% from the peak that we saw, would prompt greater, I guess, regulatory scrutiny and more regulation in other markets? Do you see that happening? Is there momentum for that?
I will say that, crypto is already a much more highly regulated sector than if we look back even, 5 years ago.
Without any regulation. Angela, the bar has been very, very low.
Yeah, so I mean, I will say that regulators are also looking at this structurally, right? And I think the focus of regulation has always been, making sure the financial sector is clean. I think regulators have acknowledged the inherent volatility of the markets, and regulation is not trying to manage that per se.
Where do you see demand coming from in the next 2 to 3 years?
I think at BitGo, what we're really seeing is a durable demand from institutional interest. So at BitGo, I think what's really driving our growth across APAC is institutional infrastructure, right? Custody, staking, trading infrastructure. We're working with regulated players like securities firms, fintechs, and even crypto exchanges that want to strengthen this. And that is a durable demand, because that for all of these players is a mid to long-term strategy.
And for BitGo, how are you capitalizing on that demand and that growth? What is your strategy in the next few years?
So I think our strategy is really to help our clients get more value out of their digital assets. I mean, if you think about your balances in a bank account, you don't just want to hold it there. So we're really good at holding digital assets securely. But I think where we are investing and where we are working with clients is to help them extract more value through our trading and staking capabilities as well. And here in Singapore, we've really invested in our BitGo, our prime brokerage capabilities. In fact, Singapore is home to our prime brokerage's largest desk across the company, and clients really value that. They value the fact that we have a deep bench of expertise that can execute in the APAC market, and that's why we've seen trading demand kind of take off in Singapore. But I think that's really only the beginning. BitGo is here to ride the institutional adoption curve, and I think we're just really at the beginning.
Angela, before we let you go, earlier we talked about how President Trump is seen pretty much like a crypto president. He's one of the greatest beneficiaries from the ride we've seen in the crypto space. Do you think he will provide that momentum, that impetus for crypto to take off from here?
I think regulatory clarity in the US has been driven under the current administration, things like the Genius Act passing and even debates around clarity, market structure. I think that has already given institutions a lot of confidence. But I think here in Asia, I would say we were even ahead of the curve, and therefore now with the global appetite opening, with the change of attitudes in the US, Asia is really benefiting from the regulatory clarity that has been set in motion even before all of these developments.
Bitcoin level by the end of this year.
There's light at the end of the tunnel, Has. There's light at the end of the tunnel.
Angela, thank you. Angela Ong, APAC MD of BitGo. Now, coming up, we speak to PL Group's Amisha Vora about the impact of India's new rules for proprietary trading firms as regulators step up efforts to cool the country's derivatives boom. Keep it here with us. This is Bloomberg. Here's a look at the market open in India. Stocks coming online just as traders grapple with a deepening chip sell-off in the rest of the region. We're keeping an eye on the benchmark Nifty index, which snapped a two-day losing streak on Wednesday, while the Nifty IT index is seeing gains after dropping for a fourth straight session yesterday. All benchmarks eking out some gains. The Nifty IT index currently up by 2.5%. The Indian rupee trading at 94.94. It is higher by 0.3%. Unusual for the Indian currency. Well, for more on the outlook for Indian markets in the second half of the year, let's bring in Amisha Vora, Chairperson and Managing Director at PL Capital Group. Amisha, good to have you with us. I mean, the Indian markets seem to be recovering. The question is really whether that recovery is sustainable.
I think it is definitely sustainable because there is a very simple trade which typically happens that when oil is high, as India imports 90% of its oil, India is short. And this was coupled also with the fact that AI trade, India didn't participate. I think both the underlying factors are fading away. Oil is back to around 70, and it is a good relief for both inflation outlook, currency outlook for India. Though in one quarter we continue to face the problem of what happened in the past, the outlook has changed substantially. And globally, I think that AI trade maybe is not in the best of the situation, and maybe some profit booking is happening. So in the process, I think India will fit in very well.
Might that outlook be impacted by a shortage in the monsoon rains, at least in the short to medium term?
That's a definite risk because Indian monsoons have not been even till now. and there is a deficiency, we do expect that to have some impact. But if you see all the reforms that were happening till now, be it GST rationalization, that is reduction, income tax reduction, the demand was catching up, but at the same time, market never took those things into account. And last 1.5 year, Indian markets were also reeling under the impact of US tariff war. So US tariff war seems to have settled from 50 and odd percent to around 18%. We have also signed our European free trade agreements, which gradually should start coming into play. And at this rupee dollar equation, the exports will start doing well. So on the whole, while the domestic consumption might get impacted a bit because of the monsoon not being so good, I think the markets as well as earnings will make it up.
How would you position yourself? Who are the winners and losers as a result of the shortage of the monsoon rains?
See, in terms of winners from monsoon reduction, there is nothing very specific. But I would still look at the portfolio construction from a different angle. And that's largely from the fact that both globally and domestically, inflation is inching up a bit. And in that scenario, the asset owners would be very well placed who have large fixed cost and low variable cost so that their earnings are still very well protected. Some of the case in point is companies like which are in ports, airports, like Adani Ports, GMR Airports, things like that. All the asset owners in different way. Some of the other ways to look at it is both rupee depreciation and a little meltdown in metals, because metal prices did exceedingly well in last 2 years. A little meltdown or consolidation in metal prices and rupee will help the manufacturing a lot, both in terms of their cost pressures on one hand, and secondly, in terms of exports. So some of these would be the themes which would help build the portfolio.
Amisha, with the expectation that earnings will be well supported, will they be supported enough for India to continue to outperform other emerging markets?
Look, this quarter, I think we still will reel under the impact of what happened post-March during the Iran war, because all the gas price hikes or unavailability will get reflected now, and all the raw material prices. But I think market will look ahead of that as the underlying factors have changed. And because of that, I think that, see, two things I think will happen. One is the foreign investors who have been consistent sellers. And in first 6 months, they've sold more than, I guess, 13 to 14 billion. If that selling pressure reduces, and they look at it, the markets, Indian markets, from the perspective that rupee appreciation will give them 5-6%. And if market gives them 7-8%, then a combined 13-14% return is not ruled out. That will change the game for Indian market, is what I'm assuming.
Amisha, I want to get your thoughts on the RBI's moves to cool the red-hot derivatives markets. What do you make of its latest move and the implications for trading activity?
Look, India, particularly NSE, was the largest exchange in terms of derivative volumes in the world, and 50% of the volume was proprietary. So the RBI move is not mainly on the market structure. It's more on the leverage availability, but it will have its impact on the volumes, on the liquidity, because even if I give that foreign prop participants of this 40-45% volume, say are 30-40%, then the rest of the 20% of the market volume now needs more earnings to match up with increased requirement of cash or collateral. That will result initially on reduced volume and higher spreads. And both will have its impact, because arbitrage business, when the cost goes up, how do you find that extra return? I think it will reduce a bit.
Amisha, thank you for your insights. Amisha Vora, Chairperson and Managing Director at PL Capital Group. And before we go, here's a look at tomorrow's show. Invesco's Fund Manager for Asia Ags Japan, Equities Fiona Yang, will be joining us to talk about her outlook for Asian and emerging market equities. And India's former Ambassador to Japan, Deepa Gopala Wada, will be discussing what Prime Minister Sane Takaichi's India visit means for both nations amid strained ties with China. And that is it for Insight. Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.